Do you want to create income in the stock market with just 400 bucks? Today, I'm going to break down selling a Sweetgreen $4 put that will generate 5% in income over just 2 months' time. I'm also going to show you a couple of other trade ideas as well. And I'm going to talk about why this might be one of the smartest small account strategies to use right now. If you're a new trader or you're working with a small account and you're looking for high probability income trades, this trade just might be for you. You see, most people think that they need thousands of dollars to start trading options, but that's just not the case. Now I'm going to walk through click by click using my screen, but before we jump right in, I want to talk a little bit about the company and how that might fit in your portfolio. Sweetgreen, the ticker is SG. They're like a fast casual food chain that's focused on healthy eating with salad bowls. It was founded about 10 years ago by 3 Georgetown students, and it's grown to over 250 locations across the country, mostly in affluent areas. We have tons of them here in LA. Now I want to be clear, they're not a fad smoothie shop. They're a branded, scalable restaurant concept with a digital app and automation strategy. And that matters because growth stocks don't just explode on hype. Now let's talk about numbers. Their most recent annual revenue is over $600 million, but they still have losses because their expenses are a bit high. They're a growth stage company, so they've been expanding locations, investing in automation, and scaling operations. So although revenue is strong, they're not profitable yet. But I want to talk about something super exciting relative to SG stock. Over 90% of the shares are held by institutional investors. This means mutual funds, hedge funds, asset managers, and billionaires. That gives me comfort holding shares like that. Now let's jump right into my Thinkorswim platform so I can show you what the numbers are, and you can see if it makes sense as a trade for yourself. Now before we jump right in, make sure you subscribe to the channel. I'm putting up a video every single day breaking down all different tickers, some inexpensive tickers, some more expensive tickers, ETFs, talking all about options and creating yourself income on a regular basis. So let's get started with a 12-month chart as we always do, and we can see that the price has been very, very depressed lately, coming down and closing on Tuesday at only $5.28. Now, the first thing that I want to do is hop into the SEC site just to take a look and see if there have been any big buyers or big sellers. So I'm going to go to the institutional disclosures, and I'm going to see the most recent 13G filing at the end of 2025. And scrolling through just shows me how Woodson Capital Management purchased about 6 million shares. As I said before, I did some due diligence before I recorded this video, and I can see that more than 90% of shares of this stock are held by institutions just like this. And the way I look at it is this. Institutions like billionaires and hedge funds have a lot of research at their disposal. So if there are big players in the industry buying this stock, I think it might be a stock for myself as well. So let's take a look and see the option chain. Now, usually I do a lot of videos on 1-week options, but in this video, I want to show you a 2-month option. We're going to look at April 17th. And because the stock price is so low, the puts are generally more expensive. So I'm going to show you a comparison of a couple of different ideas. We're going to start with a $4 strike. And what that means is if the price of SG drops below $4 before the expiration of April 17th, you're committing to buy 100 shares at $4. But if it doesn't drop, you don't buy the shares. Either way, you keep the premium. And by the way, you get paid the premium right when you make the trade. So this contract has a bid of 20 and an ask of 30. So right now there's already people lined up to take the other side of that contract to buy that contract at 20. So $20 would get dropped into your account for every $400 of risk. If we calculate our rate of return by dividing the premium into the capital required to make the trade, we're making 5% on our money for about 2 months' time. If you wanted to go a little bit more aggressive as well, you can look at a $5 contract, and that has a $60 bid and a $65 ask. So let's calculate the rate of return on that contract as well. If I'm making $60 and I'm committing to 500 in this case, well, now I'm making 12% rate of return for a period of 2 months. So if I was to annualize this out, I would be making about 72% on my money. Worst case scenario, if SG stock stays below $5 when the contract expires, I'm buying 100 shares at $5 per share, and I'm joining all of those billionaires and hedge funds also buying this stock. Then, if I wanted to, I can turn right around and sell a covered call against those shares. That would bring in even more income. And a covered call is this. I'm saying, okay, I'm okay selling my shares if it rises above a certain price. So I could sell, let's say, a $5 call. And right now, that contract is trading at $90. Of course, the price is going to change between now and the next 2 months, but it gives us a good idea of how much money we can make on selling that contract as well. And just to throw out another idea for you, we're just going to look at a next Friday put as well, February 27th. If we were to look at, for example, the 450 contract, that has a delta of 22. Now the delta is the statistical likelihood that the price is going to drop below the strike price by the time the contract expires. So it has about a 22% likelihood. And we can see the implied volatility is super high, about 155%, meaning that the market expects some volatility for this particular stock. Now, before I were to make a trade like this, I just want to see when the next earnings release for this ticker is. Because when stocks declare their earnings, there's some added volatility, and I may or may not want to invest during that time frame. So I'm just going to open up a Google page, and I'm just going to type next SG stock earnings. And I can see that their earnings is expected on February 26th. So that accounts for the extremely high implied volatility. But let's just calculate our rate of return on this 450 put, because it might be something that might be of interest to you. It's 15 bid, 25 ask. So let's say if we were to sell this contract at $15, and we're only investing $450. So a very, very small investment for each 100 shares. Well, we're making about 3% for about a week and a half's time. Not bad. So what'd you guys think? Can you totally see yourself investing $400 to make a 5% return over a 2-month period? What do you think about this strategy? Let me know in the comments what your favorite tickers are. If you like the video, smash the like button, share it with a friend, and make sure you're subscribed to the channel. Also, check out some of the upcoming live events. Happy trading!